In this episode, we share 7 reasons why you might get an unexpected tax bill this year. Let's get started.
Let's get some money.
From New Money, New Problems, it's the New Money, New Problems podcast, a show for successful professionals searching for the tools they need to navigate financial opportunities and obstacles they've never seen. Negotiating compensation, purchasing your first investment property, helping your family with money, the highs and lows of entrepreneurship. New Money brings new problems that require new solutions. Join us as we work through them together. I'm Brenton Harrison, and this is the New Money, New Problems podcast.
Hello, my name is Brenton Harrison of New Money, New Problems, and your host for the New Money, New Problems podcast. We are a couple of weeks removed from the April 15th tax filing deadline, and as a result, we are having our spring meetings with our private clients at New Money, New Problems, and a big part of that agenda in the spring is to review your most recent tax return and to give some ideas and thoughts for the tax year ahead. And as is the case every single year, when we have some clients who we haven't been able to meet with as frequently or don't have as airtight a relationship between their financial advisor, them as the client, and their tax preparer, we have clients who got unexpected tax bills. And I can tell you, it's never fun to hear that you have an unexpected $5, $10, $15, $20, $100,000 tax bill that you were unaware was coming around the corner. And for that reason, I wanted to focus this episode on some potential causes for an unexpected tax bill, specifically for high income earners, and some of the common things that we see on a yearly basis. So we're going to go through some very tax heavy topics and terminology. I'm going to do my best to give you a high level overview of the process, but here are 7 reasons that you could receive an unexpected tax bill. Number 1 is very simple. You might not have enough taxes withheld from your paycheck. If you started a job, you are going to receive a form called a W-4 from your employer. And that worksheet walks you through the makeup of your home. How many people are living in the home? How many people are earning an income? Do you have any children or dependents that are in that home? And based on how you fill out that worksheet, there is an estimate. And that's just what it is, an estimate of how much you might owe in taxes. Your employer then takes that estimate and they use it to determine how much to withhold from your biweekly or weekly or monthly paycheck. Now, if you look at the process of filing taxes, and we've gone through this in the past, you first take all of your income, the total of all your income sources, and you're able to reduce the income on which you pay taxes using tax deductions. So for example, there's above the line tax deductions that all of us can use, like pre-tax retirement contributions, health savings account, and flex spending account contributions. Then there's below the line tax deductions, also called itemized deductions. And you have to decide between using itemized deductions or using the standard deduction available to all taxpayers. These tools are used to reduce the income on which you pay taxes until you reach the point where you get to your actual taxable income. And because you have so many of these things at your disposal, and you could potentially have a partner in your relationship who is adding to your tax burden or complexities in terms of the makeup of your household, there is no perfect answer in terms of your employer knowing exactly how much they should withhold, which is why the higher your income goes up, I often encourage people, instead of filling out a W-4 for yourself, take it to your tax professional, your enrolled agent, your CPA, even if there's an H&R Block office that's nearby, and you can pay just a small fee. Ask them to get a snapshot of your tax picture in totality and give you a better idea of how much you should put for your withholding. Now, I would say that the frequency with which we see this is much lower than some of the other things that we'll share, but in terms of when it occurs, it is often right after a pay raise. Let's use, for example, a single taxpayer that has $100,000 of taxable income. You can see that the first $11,925 that they earn is only taxed at 10%. Everything from there to $48,000 or so is taxed at 12%, and everything from $48,476 to their $100,000th dollar of taxable income is taxed at 22%. So whereas the top portion of their income may fall into the 22% tax bracket, which is what's called their marginal tax rate, if you total up all the taxes at the lower percentages, they might have a lower effective tax rate, which is the actual average percent on the dollar that they pay in taxes. Now we have this person who earns $100,000 of taxable income. The top portion of their income is taxed at 22%. And right now there is about $55,000 of income that's taxed at that rate, while the balance of their income is taxed at lower levels. Well, let's say that next year they get a big promotion and they get a $25,000 raise. Not only does that mean that more of their taxable income is taxed at 22%, it also means that they have now bumped up into the 24% tax bracket. And if they've not done an adjustment of their W-4 withholding to take into consideration that raise, this is where you can see an under withholding and a tax bill at the end of the year. Number 2 is going to stay on that same subject, and it is the under withholding of bonuses and equity compensation. If you're fortunate enough to get a bonus or equity compensation like restricted stock, which we're going to cover in great detail in future episodes, you may not be aware that there's often a standard withholding percentage for bonuses and equity compensation, although more frequently seen with bonuses. And that standard percentage is 22% for bonuses under $1 million. So going back to that same example where we have a person that's a single taxpayer whose taxable income has now taken them up into the 24% marginal tax bracket. If they receive a $25,000 bonus, and we know that that bonus is in the top portion of their income and taxed at 24%, but there's only 22% withheld from that bonus, and they're going to be 2% short. And on a $25,000 bonus, that's a $500 difference between what they should have taken out at 24% versus what was actually withheld at 22%. Now, if you're talking about the difference between 22 and 24%, that's not that big of a difference. But let's say we have someone who's a single taxpayer who's actually in the 35% tax bracket, and they get a bonus that only has 22% withheld. Well, on that same $25,000 bonus, this person would have under withheld $3,250 in taxes that was due on that bonus. So you can see that as your income increases, if you don't have an idea of what the standard withholding is on your bonuses or equity compensation, how it could lead to an unfortunate surprise. And you would either need to increase that standard withholding to better reflect your status, or what many people will do is they will put that money aside when they get that bonus themselves, and they will pay quarterly taxes to reflect the difference between the withholding at their job and what's actually due on some of that extra compensation. Number 3 is a misunderstanding of the different types of taxes that are levied against your income in the first place. You see, when we pull those tax brackets up on the screen, we're talking about federal income taxes. And there are several other states, I would say most states, that will also take that taxable income, and you'll have to pay state income taxes on those dollars. However, you're also responsible for Social Security and Medicare taxes. And if you're a W-2 employee, that would be 6.2% that you owe in Social Security taxes and an additional 1.45% that you owe in Medicare taxes. So you have your federal income taxes, but you also have the separate taxes that come out of your check if you're a W-2 employee that have to be paid toward those two different programs. Now, if you're a high income earner, not all of your income may be subject to Social Security taxes. So there's a concept called the Social Security wage-based limit. And what that means is if you have someone who, say, earns $500,000, they don't owe that 6.2% in Social Security tax on the entire $500,000. They only have to pay that percentage up to the wage-based limit. In 2025, that wage-based limit is $176,100. So they would pay that 6.2% on that first $176,100. And then for any income they earn beyond that, up to their $500,000th in this example, that 6.2% tax would fall off. This is why you see a phenomenon later in the year for high income earners where they'll get like a mini pay bump on their biweekly paychecks. It's because they have already maxed out their Social Security taxes for the year, and that 6.2% drops off and they get more as a result on their end paycheck. Conversely, Medicare taxes work very differently. Not only are Medicare taxes levied against your entire income, there is no cap as to which you no longer have to pay. But if you're a high income earner, you have to pay an additional Medicare tax on top of the original 1.45%. If you're looking on screen, you can see that in 2025, for those who are married filing jointly with income above $250,000, they have to pay a Medicare surcharge tax of an additional 0.9% on income above these levels. If you're married filing separately, it's $125,000. If you're single or head of household or qualifying widower, that's $200,000. So you have people who may not understand that not only is the Medicare tax due and the Social Security tax, most of which is taken out by your employer if you are a W-2 employee. But if you have income above these levels, there's a Medicare surcharge tax that would be due as well that can often catch people unaware. Now, on top of this, if you're an entrepreneur, there's a real kick in the crotch, for lack of a better phraseology, and that is the fact that if you're a W-2 employee, I said 6.2% Social Security tax, and I said 1.45% in terms of the Medicare tax. But the reason it's those rates is because the full tax for Social Security is actually 12.4%, and the full tax for Medicare is 2.9%. But the reason it's halved for employees is because when you work for someone, the employer covers half of those taxes. But if you are an entrepreneur or an independent contractor, you instead are required to pay the full rate. You pay 12.4 and 2.9 as compared to someone who works for someone else who pays 6.2 and 1.45. So if you are a new entrepreneur and you have never had a tax return filed under this business or under this consultancy, or you just started an LLC and you are unaware of the self-employment taxes that are due on this income, an actual doubling of the tax as compared to your employee-employer status, then this is one of the most consistent tax bills that we see catch people unaware, because even if they have the discipline to set aside their federal and state income taxes, which many people don't, they may not be aware of the fact that, oh my goodness, not only am I used to my employer taking out 6.2% and 1.45%, and now I have to do that, I have to add another 6.2 and 1.45 on top of my federal income taxes. And number three, the last before we go to the break, are the taxes you owe on your non-qualified investments. And to me, I don't feel badly about this because I think it's a wonderful thing to have in your portfolio, but we are adamant in this podcast about talking about other ways to take advantage of money you have sitting on the sidelines. We've talked about the goal of having most of your savings in a high yield savings account, so you're getting a better rate of return than your local savings. We've talked about non-qualified brokerage accounts and the benefits of having that shell of an investment inside which you can place investments of your choosing that have more liquidity than what you find with your retirement account. However, you may be unaware that that interest that you earn from that high yield savings account that you just opened is interest income or investment income that is taxed at ordinary income rates. So when we talk about federal and state income tax, it is just like you earn that money in salary and you have to pay taxes as such. When you have things like your non-qualified brokerage account, you could have dividends, excess profit that is distributed by the manager of your mutual fund or index fund, or the one that is often the thing that trips people up. You could have capital gains even if your investment lost money. And this is really, really frustrating for people who have experienced this, but I'll use a mutual fund as an example. When you have a mutual fund, it is a collection of stocks and bonds that is managed by an entity. And that basket of funds is something that you can invest in with a pool of other investors. So if I'm investing in this mutual fund that has 100 different stocks and bonds, I'm putting my money in alongside the thousands or tens of thousands of other people who have invested in that fund. And that fund predated me, right? They didn't create it just for me. And as a result, there are stocks and bonds that have been in that portfolio for a long time and may have experienced gains, even though I didn't get to participate in those gains. So I now buy into this mutual fund, and let's say that they have a position with Nike that has been a big gain for them over the years, and they decide for whatever reason to sell all or a portion of their holdings in Nike inside of that fund. And they're going to distribute those gains to their investors. So if you bought into that portfolio, a portion of that gain from the Nike sale is going to be assessed and attributed to your tax return. So even if you bought in and you didn't get to ride the ride of watching your investment in that mutual fund go from 10,000 to 15,000, When you get your tax document, there's going to be a capital gain on there from the sale of that position. And it's going to be there even if your actual investment went from $10,000 to $8,000. But this is a part of what it means to have a non-qualified investment that is taxable from year to year. So you have to have an understanding of what that looks like and also build it into your strategy, because if you're a high income investor who's not trying to have a whole lot of gains in your portfolio, that can actually shape the type of investments in which you invest, which is why you see people who have large amounts of income and assets start to shift in many cases to an index-centric portfolio or a single stock portfolio, where it's either an entity that doesn't typically kick off as much gains, or in the example of single stocks, you have more control over when you buy and sell for a gain. And as a result, hopefully have a bit more predictability in terms of how it impacts your tax return. And before we hop off that topic, just like for high income earners, there is an additional Medicare surcharge that they pay for income above certain levels. For high income earners, there's also an additional tax on investment income of which they need to be aware. It's called the net investment income tax, and it's applied to the lesser of the actual investment income that you received or the amounts above certain income levels. So we're not going to get too deep into the calculation, but that tax rate is 3.8%. So in our example, if you're subject to net investment income tax, you may have an account that lost value, still have to pay 15% in capital gains tax from a distributed profit, and then have to pay an additional 3.8% on top of that in net investment income tax. These are the reasons why the more complex your strategy becomes and your holdings become, you need to have an interplay between your goals, a financial professional, and a tax professional to make sure you're prepared.
This is the New Money, New Problems podcast, a show for successful professionals searching for the tools they need to navigate financial opportunities and obstacles they've never seen. We'll be right back.
Are you wondering what new money problems you might be overlooking in your financial life? If so, we've got great news. We've crafted the New Money, New Problems Gap Finder to identify potential weaknesses in your finances in areas ranging from budgeting, investments, insurance, and even the threat your extended family's finances could pose to your household. Please head to newmoneynewproblems.com/gapfinder to complete it today. Again, that's newmoneynewproblems.com/gapfinder to take the assessment.
You're listening to the New Money, New Problems podcast. Subscribe now at newmoneynewproblems.com. Welcome back.
Welcome back from the break. We are going to go even further down the road of taxes that are surprising to the high income earner. And we're going to go next to disallowed deductions. So there's a concept that we've discussed in the past called reverse discrimination. And reverse discrimination is the idea that the more money you earn, the less you get to participate in certain benefits, be they employee benefits or tax benefits. And even higher at the income levels, you may not be able to participate in them at all. I'll give you some examples. Going back to the screen, a very popular investment that people use to set themselves up to have income tax-free dollars in retirement is the Roth IRA. Roth IRAs, you put in money that has already been taxed, and in exchange, when you pull it out in retirement, you pay no taxes. However, based on your income levels, you may not be able to participate in a Roth IRA. Looking on screen, if you have an adjusted gross income as a single person that's over $165,000, you can't contribute directly to a Roth IRA. If you're married filing jointly, $246,000. And I'm going to put a pin in this. If you're married filing separately, $10,000 is the adjusted gross income limit beyond which you can't contribute directly to a Roth IRA. We'll explain why in a second. The next is something that requires a little more of an explanation. IRA deduction phase out for active participants. So let's walk through this. A deduction means, remember, that you are using it to reduce the income on which you pay taxes. And when you put money into pre-tax IRAs, you get a dollar for dollar tax deduction. Now, the pre-tax deduction is the major benefit of using the IRA, because if you don't get the deduction, Why would you set yourself up to pay taxes twice? I have to pay taxes on the money when I put it in, and I have to pay taxes when I take it out in retirement. You wouldn't do it. However, if you're an active participant, you are restricted as to how much you can earn and still get that deduction. What is an active participant? An active participant is someone who has a retirement plan available to them at their employer, whether or not they choose to use the account. And if you're an active participant and you're single, you cannot get a deduction for pre-tax IRA contributions once your adjusted gross income goes above $89,000. Married filing jointly, $146,000. Again, married filing separately, $10,000. We'll come back to that in a second. And a spousal IRA. What this means, a spousal IRA is for a person who does not earn enough income to justify their own IRA contributions, because IRA contributions have to be based on income. You can't just make no money and contribute to an IRA. However, you can open a spousal IRA and use your spouse's income to justify your IRA contributions. But what they are saying is, if you're, say, for example, a stay-at-home spouse, and we're deciding to open up a spousal IRA, if your spouse is an active participant at their job and your family's adjusted gross income is over $246,000, you still can't get that tax deduction for the pre-tax IRA. And this is an example of reverse discrimination, either reducing the amount that they can deduct or disallowing the deduction because of how much they earn. Now, to my comment about married filing separately. If you listen to our Escape Student Loan Debt podcast, which is a separate business entity from New Money, New Problems, you're aware that there are plenty of people out there who are married and have federal student loans, but their spouse does not have federal student loans, and they don't want their spouse's income included in the calculation for their student loan payment under income-driven repayment plans. The way that you would avoid that spouse's income being included is to file your taxes married filing separately. There are other reasons why people will choose to do this. They may have a year where one person has a lot of medical expenses. There's a whole host of reasons. But when you file married filing separately, it is a very big decision. The first is because the federal income tax tables are less forgiving for people who married filing separately as compared to people who file married filing jointly. But you also, in many cases, like what we're looking at for the Roth IRA in terms of how much you can earn before you contribute, or the IRA deduction for active participants, will have a severely reduced eligibility for certain tax deductions, or you will not be able to use those deductions or tax credits at all. Example of completely disallowed deductions are the Earned Income Tax Credit, the American Opportunity Tax Credit, the student loan interest deduction if you earn below a certain amount of income. In terms of ones that are reduced, the child tax credit is reduced in terms of how much you can participate if you are filing your taxes married filing separately, as is the retirement savings credit. There are a whole host of things that you either can't do or can do less of when it comes to filing your taxes married filing separately, because this is not something that the IRS wants to incentivize. So a combination of the high income and also making the decision to file your taxes married filing separately, even if you're getting a huge benefit from your student loan payments, you would want to make sure that that benefit in terms of saved student loan payments exceeds what it's costing you in extra taxes by making that decision, because it's not one that should be taken lightly. And just in case you're keeping track, that constitutes number 4 and 5 in terms of the reason we've covered so far. Number 6 is something that does not impact a ton of people right now, but it potentially could in the future, and that's what's called the alternative minimum tax. So because it impacts so few people, we're not going to spend a tremendous amount of time. As it stands right now, if you're a single person, you'd probably need to be earning over $500,000 to be subject to this tax. If you are a couple, you would need to be earning over $1 million to be subject to this tax. But that could change, because those thresholds are basically a result of the Tax Cut and Jobs Act that was instituted in the initial Trump administration. And those tax policies are due to sunset or expire at the end of 2025. And if they go back anywhere to the levels where they were before, you're now talking about a single person who around $250,000 would need to worry about this tax, and a couple around $350,000, $400,000, which is why we're talking about it. Because if they don't extend the current thresholds, you're now bringing a lot more potential people into the fold that could be subject to this tax. But the alternative minimum tax is a parallel tax code that runs alongside the traditional federal income tax code that we've been discussing. And essentially what happens is every single year, they will calculate the taxes that you would owe under the alternative minimum tax versus what you owe on a regular federal income tax, and you have to pay the higher of the two. Now, again, right now, for the overwhelming majority of people, you're going to owe more on the regular tax code. So AMT is not a consideration. But if that's not extended, this could be a tax that's a much bigger deal for the high income taxpayer in the years that are to come. And then lastly, number 7, cost basis. And cost basis is a term that the IRS uses to determine how much of an investment sale is gain versus how much is just you recovering your basis or the skin that you already had in the game. To think about it this way, if you made a $10 investment and you sold it for $15, well, the entire $15 is not gain. The $10 of that money that you got back is you just recovering your initial investment into that vehicle. And that initial investment is called your cost basis. And you see very frequently a misunderstanding of how cost basis impacts tax returns. And you see this a lot when it comes to transferring of property, when it comes to estate planning. A mother who wants to leave a house to their son, and to make it easier to do so, they transfer the deed of that property from themselves to the name of their son, which has a ton of negative potential tax considerations when it comes to cost basis. But on a year-to-year scenario, if you're not transferring property and you're just dealing with your own investments, a misunderstanding of cost basis has to do with you selling an investment and not knowing how much was considered basis and how much was considered gain. And as a result, you don't know how much to set aside for taxes because the tax will only be due on the gain. You see this most frequently, at least I do in my dealings with people who have real estate holdings. And the reason for that is because your cost basis in real estate is often reduced by taking advantage of something called depreciation. And depreciation is, at least on paper, making your investment worth less than it is, and you get a certain tax benefit by reducing that value on paper. So you have someone who sells an investment property for $300,000, and they think that their cost basis is $100,000, but they're unaware that their tax professional has been taking depreciation on that property, and maybe as a result, their cost basis is significantly lower, and now they've undersaved. So if you have any investments, not just real estate, but also stocks, bonds, mutual funds, index funds, and you are considering selling or have sold those for a profit, you need to go back and find the cost basis for that investment so that you can properly plan for what's to come next April 15th. So I know this episode was full of tax jargon and is more technical than we like to get on this episode, but I'm still hoping that I explained it at a level high enough that it was still valuable to you. We'll be back next week with one that will be a little lighter lifting on me and hopefully you as a member of our community, and I hope to see you then.
Let's get some money.
From New Money, New Problems, this was the New Money, New Problems podcast, a show for successful professionals searching for the tools they need to navigate financial opportunities and obstacles they've never seen.